Hi, everyone. Thanks so much for being here and joining us for the Climbing Mount Debt presentation. My name is Jordan Ben-Shia. I'm the Executive Director of the VIN Foundation, and I'm here to go over a few housekeeping tips with you before we get started. You will notice there is a Q&A at the bottom of the screen. Please use that for any questions that you have. Any technical issues, please use the chat window. But if you have any questions throughout the presentation that are not technically related, please put them in the Q&A. You also have the opportunity to upvote those questions. So if you see a question that you think is pertinent to you or you want to make sure it gets answered, go ahead and click the thumbs up and that'll bump it to the top of the list. We have myself, we have Dr. Matt Holland and Dr. Paul Payan also here helping answering questions in the background. And we're very happy to be presenting this Climbing Mount Debt presentation with VCA. And at this time, I'm going to go ahead and turn it over to Shannon Bass, the Director of Specialty Recruiting for VCA.
So we are super excited to partner with the VIN Foundation because we just think that they have awesome resources for you guys about student debt. And so thank you so much for being here. And we are just happy to see folks, even if we can't see everybody in person in this crazy time, but we're happy to be here with VIN and with a bunch of residents. So thanks.
Wonderful. Thanks, Shannon. So we might pop in a couple times during the presentation to answer relevant questions. Again, any questions, pop them in the Q&A. Any technical issues, pop them in the chat. And with that, I'm going to turn it over to Dr. Tony Bartels, our student debt expert and presenter. Take it away, Tony.
Cool. Thank you, Jordan. Thank you, Shannon. Super excited to do this with veterinary medical residents. You all are a tough group to target when it comes to providing student debt information. So super excited to have this chance to try to get to you all before you finish your residencies, because I tend to hear from you after you finish your residencies, and that's when I wish I could go back and talk to your resident selves. So finally, we get to talk directly to your resident selves, and all these things that we can share with you in terms of the mistakes that other people have made before you, so you can avoid some of those same pitfalls and hopefully save yourself, tens of thousands of dollars along the way when it comes to your student loan repayment. We're going to follow a bit of a structure here, otherwise it can keep me from wandering off path. But first, you can't manage what you don't measure, right? And I know for a lot of you, the last thing you want to do after a long day of being on clinics and educating students and all of the other responsibilities you have is look at your student debt. But unfortunately, this is the best time to take a peek at it and really make sure that you're either on the right path, or if you're not, switching gears while you have this opportunity to set yourself up to pay less and spend less time in repayment. We're going to talk a lot about the different repayment options that are out there. It's gotten really, really confusing. And I know, for many of you, because I'm married to a specialist, and I got to witness this firsthand while she was going through her specialty training. Student loan repayment options are about number 150 on your list of things to do. So we're going to try to give you a quick breakdown on what you need to know in order to make those decisions and put yourself on the right track. It does require you to think ahead. So beyond your residency, what do you think you're going to do when you finish? And also, what do you think you're going to earn? I'm going to share some of the data that I have. It's pretty scant. I wish there was more data on incomes for veterinary medical residents and the different specialties, but there's not. So hopefully you all know a little bit more about the incomes for the specialties where you're heading. But I'll share with you what I have so we can at least create a working model. And then we'll apply that, right? So once we have your student debt, we have your income, we can calculate a student debt to income ratio after your residency, and then help use that information to reduce your student loan costs by choosing the appropriate repayment plan during your residency and also after you finish. And then also when we get towards the end, we're going to cover some of those questions that you all submitted as part of the registration. How am I going to buy a home? Can I still save for retirement? All of these other financial goals that you may have, even though you have a lot of student debt, right? And you can do both. It is definitely possible to manage your student debt and to accomplish all of those financial goals that you mentioned in your questions. We also have to address the other elephant in the room, right? The COVID-19. Hopefully everybody has been safe and otherwise healthy, and your families as well during this bizarro pandemic we're all kind of navigating. But there are some interesting impacts to your student loans, particularly federal student loans, and we'll make sure that we identify those and clear up any questions that you might have regarding what's happening with your student loans during this pandemic. We do take a clinical approach to your student debt, right? I mean, that's how we're all trained, so it seems to make the most sense, right? So we're not going too far out on a limb here, but in the first half of the presentation, we'll do some physical exam and diagnostics on your student loans using some of the tools on VIN Foundation and the Student Debt Center. And then we'll use what we find in that physical exam and those diagnostics to create some prescriptions and treatment plans around our student loans and repayment strategy. So ideally, what can you do now as residents to lessen the stress around your student debt and hopefully pay less over time, reduce the amount of time that you spend in repayment, and increase the flexibility so you can navigate any curveballs or different career paths that you may pursue after your residency. Just to kind of establish a baseline here, one of the reasons that we do all this type of education with veterinary students, veterinarians, residents, I mean, clearly we have a student debt issue in veterinary medicine, right? A lot of it depends on where you went to school, right? So we see a lot of variation between the different debt that is reported among the different schools. And this is from the 2018 graduating class. So some of you may be around or near that graduation year. But the incomes, at least for general practitioners that go on to private practice, doesn't vary a whole lot, right? So student debt is an issue, and it really depends on where you went to school and how much you ended up paying for that education and how much you had to rely on student loans for that particular education. But we can see that it can range anywhere from 75,000 at Texas A&M all the way to more than 300,000 at Midwestern University and even beyond that. We do use debt to income ratio a lot, right? So this is another one of those key performance metrics that AVMA uses for new graduate veterinarians, but we can apply that same concept to residents and those beyond in their specialties in terms of choosing a repayment strategy. So we take our student debt, divide it by our income, and that gives us a debt to income ratio. And this is the debt to income ratio for recent graduates at the time of graduation, right? So what we really want you to be focused on is what is your debt to income ratio going to be once you complete your residency, because your debt to income ratios now are likely not very favorable, right? So we're not too concerned. We understand that interns, residents don't make very much, so we're not too concerned with the debt to income ratio now, but we are looking to know what your debt to income ratio is once you finish that specialty training. So I spent a lot of time helping our colleagues with their student loan questions and helping them develop strategies for paying back their student loans. And I asked them for their student loan history and signalment. So this is a little bit of mine. So we're a married 2-vet household, a couple of Labradoodles, but no kids yet. Fairly recent graduates, right? So both of us went to Colorado State. I finished in 2012. My wife finished in 2009. She went on to specialize in small animal internal medicine and practices where we live in Denver. And I went more the GP route and did a combined MBA DVM at Colorado State. But together we have more than $400,000 in student debt. Right? So we're living this, right? Trying to figure out the best student loan repayment strategy from the many that are available, and as well as meeting all of our other financial goals. If you do nothing, right, and if you've done nothing with your student loans other than maybe put them in a deferment since you graduated veterinary school, once you actually enter repayment, the default repayment plan is the standard 10-year plan, right? So the standard 10-year plan takes your student debt balance, the interest, and then calculates a monthly payment to extinguish that balance over a 10-year period, 120 monthly payments. So for us, with $400,000 of student debt, that was going to be about a $4,500 per month payment, which was not part of our financial strategy. It just wasn't even doable. Right? So stumble upon these income-driven repayment plans. The first one we started with was called income-based repayment. And as the name implies, the payment is a function of your income. Right? So it's at one point that had us at $1,400 per month. And then we switched to a newer version of a plan, sorry, that COVID label, wasn't supposed to come on until later, but we switched to a newer version of an income-driven repayment plan called Revised Pay-As-You-Earn, or Repay, and that had us down to about $930 per month at one point. And then the reason why we have this COVID-19 label here is because for federally held student loans, there are currently no payments due on student loans, and the interest rates are all set to zero, right? So if you have federally held student loans, you do not have any interest accruing, and you also do not have a payment if your loans are in repayment. As many of you may have heard or might know something about, if you use an income-driven repayment plan, there's always the potential to hit student loan forgiveness, right? So you make payments that are based on your income. Like I shared here, our payment was $930 per month at one point, but $930 per month is not even going to cover the interest on a $400,000 student balance. The Department of Education allows you to do that, right? Your loans are still considered to be in good standing. But it is quite likely that both my wife and I are going to have a balance remaining when we hit the maximum repayment period under Revised Pay-As-You-Earn, and that is going to trigger a taxable event. Right? So in addition to the minimum monthly payment that we make when we have a payment due, when we're not in a pandemic, we're also stashing away some money for that anticipated tax that's going to be due once we reach forgiveness. And we are about 60% to our target, what we anticipate that tax bill to be, with about 17 years to go, right? So we're well ahead of schedule, right? So we're not quite halfway through that maximum repayment period for repay, but we're more than halfway to our anticipated tax target. So you can check all this, right? So some of you submitted some of these as part of that student loan history and signalment form. So thank you for doing that. I'm going to kind of walk you through how you can complete that, how you can find that information here. But studentaid.gov is going to be the place where you're going to identify your current federal student loans, and then we can use that information to build upon, identifying the income-driven repayment plans that you're eligible for, and whether or not you're eligible for this pandemic student loan repayment relief as well. So in the student aid portal, you're going to see something like this, and we're going to head over there because that's one of the great things about doing these via Zoom is we can actually drive around on the computer screen and show you those sorts of things. So let me come over here. Actually, I'm going to go to studentaid.gov. Right, and this may look familiar. I don't want to cause any trauma, but this is where you went and actually applied for your federal student loans, right? So this is the platform now that the Department of Education uses when you filled out FAFSA and applied for your student loans. This is also where the history of all of your student loans resides, right? So you can see here, this is my share of the student loan balance. So I've got about 172,000, 164 of that is principal. About 7,800 of that is interest, unpaid interest, right? So this is my loan balance growing because our payment doesn't quite cover the interest, right? So we'll talk more about that, but you can have this phenomenon when you use an income-driven repayment plan. But what we're looking for in here is view details, right? So you're going to land on this dashboard when you log in to studentaid.gov. You're going to click on this view details, and this is going to take you to a page that has more information. And what you're looking for is this download my aid data, right? So this is going to be the link that you click on, right? And it allows you to download your federal loan history as an ugly looking text file. And that's the text file that you want. So you click on that, it'll save that text file to your computer, and then you can actually come over to the VIN Foundation My Student Loans tool and put that in there. That's where we're going to go next, right? So I'm going to come over to the vinfoundation.org Student Debt Center, right? And this is free. You do not have to be a VIN member to use this. Anybody can use this, although it is designed specifically for veterinarians. Anybody can use it. It's a public site, right? Because we want everybody to have access to the tools that we've created here to make sense of student loan repayment. But once you have that text file, you're going to come over to My Student Loans, and you're going to have three choices, right? And you've all graduated from veterinary school, so the choice here is going to be pretty obvious. You're going to take that student aid data file. Got an example one here that will work from. And this is going to create a summary of information for you, right? So this is going to boil down your student loans and at least pull out or tease out the information that's going to be most relevant to developing a repayment strategy, right? So you can see we've got 18 different loans here. All of those different loans are going to have slightly different interest rates. If we add them all up, we get a principal. And in this case, this person's been using an income-driven repayment plan, right? So they have some unpaid interest as well. If you're in deferment, you may also have some unpaid interest before they turned off those interest rates, right? So unpaid interest is essentially the interest that is accrued on your principal before you've had a chance to pay it. Or if you're using a repayment plan, it's the amount that's remaining after you make a payment that's not quite equal to the interest that's accruing, right? But you still owe the whole amount. So that's the total. And then we're also going to take all of these different interest rates and calculate a weighted average, right? So we can work from your loans as a single portfolio, essentially, as opposed to trying to figure out, well, which ones of these loans do I attack first, right? And generally speaking, when it comes to student loans, you're not gonna make a lot of gain a lot of ground by trying to pick and choose which loans here to target individually. You're going to want to kind of treat this like it's a single loan portfolio, and you can do that with this weighted average interest rate. And if you consolidate your loans, that's essentially what the Department of Education did, right? They're going to take all those loans and create a single loan that has a weighted average interest rate, which is essentially, all of the different interest rates here based on the principal balance weighted and averaged out. One of the most valuable pieces of information in here is your income-driven repayment eligibility, right? So all of the different plans have some interesting qualification requirements, right? And when we first started doing this, I probably spent a majority of my time just wading through those files and helping people understand which repayment options they actually had available to them. Your loan servicers sometimes get this wrong, right? So we've built all of the algorithms into the My Student Loans tool here. So if you upload that file, we'll show you which repayment plans that you're eligible to use. Here we can see that this person qualifies, their entire balance qualifies for the old version of IVR. Part of it, or almost all of it, qualifies for pay as you earn, and almost all of it qualifies for revised pay as you earn. So I mentioned before that my wife and I use revised pay as you earn, and that's because we don't meet this qualification requirement for pay as you earn. We both had loans from before October 1st, 2007, right? So I imagine that's, most of you are going to qualify for pay as you earn if you're not already using it, but you're going to want to check this income-driven repayment eligibility tab just to be sure. The reason why this doesn't say 100% is this person has some different loan types, right? So direct loans are the ones that you're really looking for. Direct loans are the ones that qualify for all of the most beneficial repayment options and programs like public service loan forgiveness. But this person has a very small amount of student loan balance that exists in the program that was there prior to the direct loans being the predominant loan type, right? So this is only a possibility if you started your higher education career before July of 2010, right? So another one of those date ranges that, if you're not quite sure what types of student loans you have, the first step is to just go grab that federal student aid data file, put it in the My Student Loans tool, and we'll break it down for you, right? If you didn't start school until after 2010, then you don't have to worry about these FFEL program loans, right? But this is valuable information to know how much of my portfolio is in which particular loan programs, and we're predominantly concerned with direct loans here. I did see a couple of you that submitted the Signalman form had some health profession student loans and loans for disadvantaged students. Those are not going to live in this system, but they are a type of federal student loan, and you can add those after you upload your file. You can account for those separately, right? So you can add that balance here. If you had, I think somebody's submitted or shared in one of their files that they had about $40,000 in health profession student loans, which is great, right? Those are subsidized loans that didn't cost you any interest during school, but they can be a little problematic in repayment because they aren't technically eligible for any of these income-driven repayment plans unless you consolidate them, which we'll talk about later. But this is just essentially an accounting exercise, right? So you want to account for the loans that you have currently, right, and put them all into here to understand what you're dealing with first, right? And then we can also help you with that weighted average interest rate and identifying which loans qualify for these things like the CARES Act as well as the different income-driven repayment plans. All right, so this is kind of stuff I kind of covered already, right? So health professional student loans are not in there. Loans for disadvantaged students are not in there. Private loans are also not going to be in that federal student aid file, just loans that you pretty much obtain via that FAFSA application. If you have lost track of any student loans, you're going to want to check your credit report. This is a good habit to get into. You can get a free credit history from the 3 major reporting entities once per year. You want to know what's on that report before the bank finds out, right? So this comes up quite frequently. I was working with a surgeon a few years back, and he was wondering why he couldn't actually get a loan for a house, and he came to find out that he forgot about a loan from undergrad that he hadn't made any payments on, and it was in default, right? So there's things that you may have either lost track of over the years or what have you, and you may want to check that credit report just to find out, because it's one of those things that can prevent you from getting a home or buying a practice or renting an apartment or buying a car or any of those things, particularly if there's something bad on there. So we went through this, right? So you can download your student aid data file, upload it into the VIN Foundation My Student Loans tool, and get all of that summary information that we just went through, and add those health profession student loans and loans for disadvantaged students into that accounting if you have those. Just want to cover the CARES Act really quickly. So this was legislation passed by Congress earlier this year as a result of the pandemic. And essentially what it did was suspended any payments that you had to make. And it also turned the interest off on your student loans, which was a huge bonus, right, for those of us that have student loans. It was originally set to expire at the end of September, but then the president extended it through presidential action through at least the end of this year. Right, so we don't know what's going to happen January 1st just yet. There's still some bantering about in Congress in terms of extending some additional relief. Doesn't look like it's going anywhere just yet, but who knows? Those things change all the time. But keep an eye on this, right? We could see this get extended beyond the first of the year. But as of right now, if they don't change anything, or if there's no more additional presidential directions, then our interest will start accruing. And if you are in repayment, it'll start that payment cycle again at the first of the year. If you are receiving any kind of employer contributions for this tax year, they would be considered tax deductible. You don't have to pay tax on any of those as you did previously. There is no action required on your part for this. If you have federally held student loans, they automatically apply this. Right, so you don't have to request it. It's just automatically applied to those loan types that qualify. All right, so we're going to talk a little bit about repayment options that are out there. And so the kind of the beaten path is the standard. So a standard 10-year plan, like the default repayment plan, you can extend it beyond 10 years to 20, 25 years, even 30 years. There's a graduated repayment option as well. Basically, you pay interest only for the first couple of years, and then every 2 years, the payment goes up until you pay the balance to zero. I don't recommend a graduated plan for anybody. They're typically the most expensive repayment options, and there's just way better options available now. Deferment and forbearance, those are options that are used extensively, particularly by interns and residents in veterinary medicine, and that's what we're going to spend a lot of time on, right? So deferment and forbearance are not your friend when it comes to student loan repayment, and we'll talk about why that is. A private refinance, a lot of people are under the impression that all I need to do is refinance my student loans at a lower interest rate and everything will be fine. A private refi is essentially a standard or extended plan. Ideally, you would also get a lower interest rate if your credit history determines that you should, and your negotiation abilities determine that you should, but it's really no different than a standard or extended repayment plan. It's still kind of the same time-based repayment option. We do have these income-driven repayment options that are available, and they're really unique and only apply to your federal student loans, right? So, and these can be extremely beneficial, particularly when we see the types of balances that exist in veterinary medicine, right? So some of the balances that you shared with me, the balances that I see from our colleagues on a daily basis, $200,000, $300,000, $400,000. I mean, this is where these income-driven repayment plans shine, and they can be particularly helpful during an internship residency path as well. So there's a whole list of them here that are available. They all have different features. So choosing the right one is challenging, and also choosing the right one can save you tens of thousands of dollars over the course of repayment. Some of you also asked a lot of questions about public service loan forgiveness. We're going to talk a lot about that. So public service loan forgiveness is not actually a repayment option, right? It's actually a benefit that you might qualify for if you do all of the right things. And one of those right things is using an income-driven repayment plan, right? So you have to know enough about the income-driven repayment plans to successfully navigate public service loan forgiveness. But we're going to talk about that in just a few. All right, so why should you care now, right? And this is why I'm so excited to do this for residents. It's because you probably don't have a time machine. If you do, please share it, right? Because I got a few things I need to clean up. But this is the kind of information that I hear from specialists after they have, after we kind of go through something similar here, but then you kind of realize, oh, well, I can't go back and make up for that time during my residency or internship, right? So, and this is the one that is particularly maddening for me, is that a lot of our colleagues are either hearing from current specialists or their mentors or whoever that deferment and forbearance is the best way to go, right? And it's just not helpful, right? And we're gonna talk about why that is. And then also, if you're, this time that you're in your residency, depending on your circumstances, might actually qualify for public service loan forgiveness, right? So you want to make sure that you're doing or gaining credit for public service loan forgiveness, or even the taxable version of forgiveness, if you anticipate hitting that tax, right? You want that to happen as soon as possible, right? So making sure that you're getting credit for that time served, if you will, as soon as possible is really what we're going for. The two different types of repayment options that you're going to have available for you fall into two broad categories, right? So either time-driven repayment or income-driven repayment, right? So time-driven is kind of traditional standard repayment plans. Pretty much any loan, any other loan you're going to have outside of your student loans are going to operate under a time-driven repayment strategy. So you've got an amount of loan, you've got an interest rate, an amount of time that you're going to pay it back. That's what generates the monthly payment. The income-driven repayment plans are going to take into account your income, your family size, and the plan type that you choose, and that's going to generate your monthly payment and determine whether or not you hit a tax like my wife and I are going to probably hit, or if you hit public service loan forgiveness and you don't have to pay the tax. There are tons of different calculators out there for helping you understand what the cost is for a time-driven repayment option, right? This is not a secret. You can just search the internet for any loan calculator. You put in your principal, your interest, and they'll crank out a monthly payment, right? Those are pretty straightforward. On the income-driven side, it's a little bit more complicated, right? And that's where we're going to have to turn to some of the tools that we have in VIN Foundation with the Student Loan Repayment Simulator. The Department of Education also has a repayment simulator, but it's not nearly as robust as the one we built, right? It doesn't have all the income inputs and the ability to change them as we can for the one that we built on VIN Foundation. Sometimes, and you all may experience this, right? So this is it may make sense for some of you to move from an income-driven repayment strategy to a time-driven repayment strategy after you finish your specialty training and start earning more money, right? But it's going to be really dependent upon your debt to income ratio and when that debt to income ratio gets below something like 1, right? So when your income exceeds your debt, or if your income exceeds your debt, that's going to be what dictates this. What I generally see happening is people starting with a time-driven plan, and then they, throw their hands up and say, there's got to be a different way to do this. And then they move to an income-driven plan, right? That's costly, right? I mean, you can certainly do that. There's nothing preventing you from doing that. And if it makes sense for you, you should do that. But it's better if you start with the income-driven plan and then switch to a time-driven plan versus starting with the time and moving to the income-driven one, right? Because this is going to cost you time and money moving from the time-driven to the income-driven. All right, so I just show this just to make sure that everybody is aware that it is here, but not all income-driven plans are created equal, right? There's several different ones that are out there. They all have different features, and all of this is baked into the student loan repayment simulator, the VIN Foundation student loan repayment simulator. The only thing that's not in the simulator is income contingent repayment, ICR, and that's because I have yet to find an instance where ICR is better than any of these plans. The only time it might apply is if you're a parent yourself and you are borrowing for your kids' education, that's one of the only available income-driven plans for what are called Parent Plus loans, right? So if your parents actually have loans that they took for you, right, they could use ICR, right? But there's no way for you to take those loans and put them into your income-driven repayment plan. So we exclude ICR, but I do keep it in here just to illustrate that it's an option and to kind of show the history of how this works, right? So income-driven repayment, the payments are a function of your income. ICR, which started way back in 1994 and is still available, was based on 20% of your discretionary income. But unfortunately, this didn't usually provide a very favorable monthly payment. So we've improved upon them. The earlier version of IBR was 15%, and now the newest versions of income-driven repayment have us down to a 10% of discretionary income calculation for a monthly payment. Right, so what does that look like? So discretionary income. Discretionary income is a really simple formula that's described by the Department of Education. They're going to take your taxable income and they're going to subtract off 150% of the federal poverty guidelines. You can look up those federal poverty guidelines. They change every year. But the hardest part is filling in the income part, right? And this is probably the most robust data set we have on specialty income, right? And it's not very robust at all. So, it does have a significant number of responses, which is great, right? So this is from the Economic State of the Profession from 2019, but it lumped all of the board certifications into one category. And this is what we have, right? So the average that was reported then was about 130,000. If you're at a higher percentile here, 170, 240, right? The average was 145, right? So median was 130, sorry. So the average was 145. It would be great. I would love for you all who are heading into your respective specialties to push back on some of those specialty colleges and get them to either start collecting some income data and publishing it, or somehow we're going to have to figure this out, right? Because we have some really, really good income data for the overall profession, but we've got some pretty abysmal income data when it comes to the specialties. So I would encourage all of you to try to, push on your respective specialty colleges to start collecting that information and publishing it, so you all that are going through residencies actually have some knowledge of what to expect when it comes to income. But we'll work from this. We're going to use about 170 just to get the conversation started. But hopefully you all have a little bit better idea of what you expect to earn once you complete your specialty training and board certification. But just for illustration purposes, if we put $170,000 in here into this equation in a family size of 1, we're going to subtract off this 1.5 times the federal poverty guideline. So 12,760, that's the federal poverty guideline for a family size of 1 in the lower 48 states. So we're going to end up with a discretionary income of about $151,000, right? And if we take 10% of that and divide it by 12 months, our income requires us to pay about $1,257 per month. Ironically, when I did this calculation, this is what pre-veterinary students say that they're willing to pay for their student loans after they graduate veterinary school, which I find kind of interesting. But it requires an income of about $170,000, which new grad veterinarians are not making, right? But specialists have the opportunity to make that after they finish their specialty training. And that this is what that calculation comes out to. So is there a magic number you should pay on your student loans each month? I would start with this, right? Because this is what you are required to pay if you use one of those income-driven repayment plans. So start with how much does my income require me to pay, and then compare that against what you were planning on paying, or compare it to a standard 10-year plan or some other more aggressive repayment strategy, and see if there's a significant difference, right? If there's a significant difference, then you're probably going to want to use the income-driven repayment strategy so you can free up some cash flow in your budget so you can do those things like save for a home, save for retirement, have kids, right? Start a family, buy a practice, all these things that people generally want to be able to do, but feel like they might not be able to because they have to address their student loans, right? So how much does your income require you to pay? But there is
Yep. We've got a question that I think would be relevant right now.
Sure.
Somebody asked, if your income changes mid-year, say June or July, how quickly do you need to notify your loan officer if you're in an IBR plan?
Yeah, you don't, right? So, so again, if you look at this equation carefully, it's your taxable income, right? So the easiest way to do this is to use your most recent tax return, right? And they're not trying to approximate, they're not trying to generate a monthly payment based on every monthly pay stub that you receive, right? They're using your tax return as a approximation of your taxable income, and they're going to set your payment to this amount, right? Assuming this was your taxable income, they'll set it to this amount for the next 12 months, right? So that will be this payment that's set for 12 months. And then if your income goes up during that year, and when you file your tax return and then renew your income documentation again, and they pull your tax return and your income is maybe $220,000 a year, your payment's going to go up to something that is reflective of that $220,000 per year, right? So it's based on your prior year's tax return. Now, if your prior year's tax return is an overestimate, then you can use a pay stub, right? But you really only want to do that if your tax return is an overrepresentation of your current income situation, right? So this is a, it's your taxable income is usually the best measure to go off of, unless maybe you change jobs or your income decreased or you took some time off or whatever the case might be. Then you might want to use a pay stub to provide a more accurate representation of your current income. But yeah, good. Yeah, that's a great question. So there was somebody also submitted a question about making too much money, right? So is it going to bump me out of an income driven repayment plan? And no, you can't. Once you start using an income driven plan, they won't kick you out, right? The worst thing that can happen is they'll set your payment to a standard 10-year monthly payment amount, right? That would be the maximum it could be if your income was high enough where it would generate a payment that was above a standard 10-year plan payment. They actually cap it at that standard 10-year monthly plan payment under a plan like Pay As You Earn, right? So you're still in income-driven repayment at that point, but your payment reverts essentially to a standard 10-year plan payment, which at that point is less than 10% of your discretionary income. So that's when it makes sense to pay more. Yeah, we just kind of covered this with that question. So you can your tax return, they're actually going to use the adjusted gross income number, right? So that's a specific line on your tax return, and they're going to pull that number right off your tax return to plug into this equation. Now, if you can't use your tax return or you don't want to use your tax return, you can submit a pay stub, but it's going to be more beneficial for you to document all of those kind of non-taxable items that might be in your pay stub, like 401k contributions or health insurance premiums, or if you have access to a health savings account, right? All of those things are pre-tax items, and you don't want your loan servicer to include those things in your student loan calculation, right? So that's probably more for when you get to a point where you're earning more than a resident salary, but your adjusted gross income is the line item that they use on your tax return. All right, so there's only a maximum amount of time that you can spend in an income-driven repayment plan. And this is what makes them really unique, right? You're not going to be in these things forever, right? You're not going to be paying on your student loans until you die, right? There's a maximum repayment period that is set for each plan. So Pay As You Earn, the new version of IVR, is 20 years, right? So if you started from the time you graduated in an income-driven plan like Pay As You Earn, once you reach the maximum repayment period 20 years from then, if you still had a balance, that's what triggers forgiveness. Right? So you either hit forgiveness because you hit this 20-year period and you still have a balance, or you pay the loan to zero before you hit that maximum repayment period. For revised Pay As You Earn is 25 years, right? So, and this is kind of the kicker for my wife and I. I would love for loan repayment to be over sooner, but we don't qualify for Pay As You Earn, right? So we're kind of stuck with the 25-year one. However, Repay has this really interesting benefit that comes with it. And if we're making a payment that is less than the income or less than the interest that accrues, then the government pays half of that interest, right? So if we're accruing $1,000 a month of interest and we're paying $500 per month, we're falling short by $500. The government kicks in $250 per month, right? So this can be a really helpful provision, particularly for those of us who have a high amount of student debt. Or for those of you who anticipate having your income exceed your debt shortly after you finish your specialty training, Repay can be really helpful while you're doing your specialty training, right? Because if you defer your student loans, right, you're going to accrue the full amount of interest, right? And this presumes no pandemic relief, right? So right now, everybody's interest is zero, which is great, but that's not reality, right? That is going to end at some point, unfortunately, right? So when they turn the interest back on, Repay will actually cover half of your interest even during your internship or residency training if you're using Repay. Now, that doesn't mean you should all automatically use Repay. You have to kind of take a targeted approach here. If you are going to end up paying your student loans to zero before you hit forgiveness, which takes a little bit of a crystal ball, right? Then you want to use Repay during your specialty training. But if you think you're going to hit student loan forgiveness and have to pay the tax, then you're going to want to use pay as you earn, right? And that's what we're going to be focusing more of the remaining part of the session on is how do you differentiate which one of those strategies is going to work best for you. If you get married, some of you are asking some questions about what happens when I get married. One of the reasons why pay as you earn is generally the most favorable repayment option for veterinarians is because it's the most flexible and it has the shortest repayment duration, right? And when I say most flexible, one of those areas of flexibility comes when or if you are married, right? So if you're married, you have the option of separating your income from your spouse under a plan like pay as you earn. Revised pay as you earn doesn't allow that, right? I mean, I can file my taxes separately from my wife while we're using Repay, but they're still going to want to see her income when I file my income driven repayment application, right? So they're not going to process that unless they get my spouse's income documentation. For pay as you earn, as long as you file your taxes separately, they will let you exclude your spouse's income, right? So this is where it gets really, really confusing. But we do allow you to factor this in the student loan repayment simulator, right? So this is one of the real powerful areas of the simulator where you can switch your tax filing status and you can see the impact of that on your long-term repayment costs. And then the last thing we have to differentiate here is between public service loan forgiveness and the taxable version of forgiveness that we've been talking about. And we'll spend a few minutes here just talking about public service loan forgiveness. So public service loan forgiveness is that benefit that you can qualify for if you do all of the right things. And the right things are having the right loans in the right repayment plans while working in the right job or combination of jobs, right? So this is pretty much your checklist here. So federal direct loans, right? So that's the benefit of obtaining that student aid data file, downloading it and putting it into the VIN Foundation My Student Loans tool will show you that breakdown of direct loans versus any other loans you have. For those of you that submitted your signalment form and had those health profession student loans or loans for disadvantaged students, those are not direct loans, right? So in order to get them to qualify for something like public service loan forgiveness, you're going to have to consolidate them into a direct loan, right? That's how you can get those loans to qualify for something like public service loan forgiveness or pay or repay. You have to make 120 on-time payments over a period of 10 years, right? At least 10 years. And here's the repayment plans that are eligible for public service loan forgiveness, right? So income-driven repayment plans qualify, or a standard 10-year monthly plan payment qualifies. However, this is a bit of a cruel joke, right? If you make payments under a standard 10-year plan for 10 years, you're not going to have anything left to forgive, right? But if in case you did make a couple of payments under a standard 10-year plan, they will still count those towards public service loan forgiveness. But for all intents and purposes, you have to use an income-driven repayment plan in order to be making a public service loan forgiveness qualifying payment. You can have zero amounts like we have now, right? And this was actually specified in the CARES Act, right? So if you were using an income-driven repayment plan and you were qualifying towards public service loan forgiveness previously, even this period where there's no interest and no payments due still counts towards public service loan forgiveness, right? So that's another, just a huge benefit when you're going through something like specialty training and making little or no income, or we have these periods where they turn off your student loan payments. The other satisfying requirement is a full-time employee with a state, federal, local 501c3 organization, right? And that means you have to average 30 hours per week. So the question always comes up about, do residencies qualify for public service loan forgiveness? And the answer is it depends, right? In the human medical world, they all do, right? But in the veterinary medical world, some do. I think they all could. It just really depends on the people that are in charge there and whether or not they're willing to consider you an employee, right? You all are very well aware that you live somewhere in between employee, student, indentured servant. I mean, but if you can get the powers that be to call you an employee, then you're going to be able to satisfy the public service loan forgiveness if your residency is at an academic institution, right? So I would take there's a public service loan forgiveness um, certification form, right? So if you have any question about that, print out that form because your employer actually has to fill out part of that form. So take that form over to, whoever produces your paychecks, or if you have questions about your pay stubs or whatever in your residency, take that to their office and say, hey, I'd like to have this time qualify for public service loan forgiveness. Have you ever filled out one of these forms before? And they'll either say, yeah, sure, we do this for all of our residents, or they'll be like, I've never really seen one of these before. That doesn't mean it doesn't qualify. It just means that you might be blazing that path yourself, but it can be well worth it, particularly if you anticipate remaining in academia or otherwise working for a 501c3 after your residency training is complete, right? You'd really like to get that 3-4 years to qualify towards that. So you're, nearly halfway towards forgiveness once you finish that training. The early returns of this have not gone well, if you've been following the news at all. So as of June of this year, we've had 159,000 borrowers apply, and that's since 2017, right? 2017 kind of marked the first 10-year period that people could have been eligible for this. 159,000 borrowers have applied, about 4,000 have been granted, right? Believe it or not, this is a significant improvement on where it had started. And I think we're only going to see this number increase greatly as we go forward. There are very specific reasons for this. It's not because the government decided they didn't want to give anybody forgiveness. It's because it was very difficult way back when this was instituted to meet all of these requirements. Everybody pretty much had this one nailed, right? The full-time employment with a public service organization, but they didn't either use the right repayment plan or they had the wrong loan types, right? So they're still working through how they're going to help those people either qualify for that or get them on the right path to do so. But that just means that you can learn from their mistakes, right? There's no reason for anybody to make those same mistakes now because there's a lot more information out there, and we have these things like the employment certification form to check in and help us make sure we're on the right path. Any other questions on public service loan forgiveness? I know
there is one here.
Yeah. All right, great.
It says, I spoke with the people at Fed Loans, and payments during the CARES Act only count towards PSLF if you take your loans out of forbearance. Otherwise, any payments you make right now, loans are technically in deferment, do not count.
Yeah, unfortunately, that's not true. So that's another one of those really, really common occurrences with the loan servicers. And that's really unfortunate that Fed Loan Servicing told you that too, because they're the ones that actually monitor public service loan forgiveness progress, right? So as long as your loans were in repayment, in a qualifying repayment plan prior to when we entered the CARES Act, and you were already on track, making qualifying public service loan forgiveness payments, that time does count, right? So you don't have to end the forbearance to start the payment. It specifically says that in the law, actually. So, if you have any questions about that, or if you want me to pull out those statements that are actually in the CARES Act law, I'm happy to send those to you so you can follow up with them and make sure that you get those qualifying payments on your record. Okay, so what is the best and quickest way to pay off your student loans? And oftentimes I think the conventional wisdom, particularly when it comes to internship and residency training, is to defer and then pay them off as fast as possible as soon as you get done with your specialty training. But unfortunately, with student loans, and because of the income-driven repayment plans, the best is not always the fastest way to pay off your student loans, and the fastest is not always the cheapest, right? So, and this is really unique to your federal student loans. So we're gonna challenge that a little bit here, and we're gonna do that with a case. And this is kind of in between some of the student loan amounts that you all sent to me as part of your forms, right? So, there was a few of you that sent me some balances that were higher than that, a few that were just slightly less. So this is kind of right in the middle. But let's say you've got a $35,000 taxable residency income. This is the average, right? If you live in California, it's going to be higher because there's been some laws that are passed recently there where they have to pay you more as a resident now. But if you're doing your residency anywhere but California, you're probably going to be closer to this average. And then we're going to use again that $170,000 taxable income after your residency. We do have some documents here, and I'll make sure that you guys have access to this presentation afterwards on deferment and income-driven repayment that you can reference. But unfortunately, what deferment does is it doesn't count towards forgiveness. It doesn't count towards public service loan forgiveness. Your interest still accrues, and then once your deferment period ends, they take that interest and they add it to your principal, right? So if this person was deferring their student loans and they were a year or two into this, they can expect to have another maybe $35,000 of interest that would get added to their principal, and that's what's going to generate the interest on their student loans going forward, right? If you stay out of deferment, you'll still end up accruing the interest, but you can keep that interest from capitalizing. You can prevent that interest from getting added to your principal, and that can lead to tens of thousands of dollars of savings, whether you pay your loans to zero or you use forgiveness, right? So you want to prevent that interest from getting added to your principal, right? So that's the goal here. And you want to get credit towards forgiveness, right? So whether you're going to hit it or not, or if you're working towards public service loan forgiveness, you need that forgiveness clock to tick, right? And deferment does not count towards forgiveness, right? And that could have been part of the reason too for the person who made the comment about Fed loan servicing. If your loans were in deferment first, then you were going to have to figure out a way to get them into repayment, so into an income-driven repayment plan, in order to get them to qualify towards public service loan forgiveness. So what does this look like, right? This is where we're going to introduce the VIN Foundation Student Loan Repayment Simulator. So if we enter our student debt in there and we enter our best guess of income as a resident and beyond, we can start to compare something like a standard 10-year plan or an extended plan against all of the income-driven repayment options, right? But how are we going to know if it's less expensive to do something like this, pay our loans to zero as fast as we can, or we use something like pay as you earn in this green line, where we make payments based on our income, our student balance increases. At some point here, when we start earning more money, we're going to start knocking some of that balance off, but we still don't pay it to zero and end up incurring a tax at the end. How am I going to know if it makes more sense to do it this way versus a more traditional repayment method? And that's where we're going to take a peek at the student loan repayment simulator. And I actually did a little spreadsheet too that you guys can all have access to that illustrates this. But let me pull up, just grabbing the link here. So you can save these simulations and we can load them up on the simulator. All right, so I'm going to take you back up to the top here. So we're going to assume this person graduated a couple of years ago, did an internship, accrued some interest, right? Maybe made no payments on their student loans during that internship year, and now they're in their first year of their residency. So they've got about 2 years of repayment since graduation, assuming that they entered in pay as you earn when they first started there, right? And then we're going to guesstimate what our income is going to be after we finish our specialty training, right? So we have to alter the next few years to reflect what our residency income would be, right? And you can, I'm using a gross income number here, but if you know the taxable income and if you have any, pre-tax benefits as a resident, you might want to account for those here, right? And then we're going to start our income after that third year of residency. I've got about a half a year's worth of income here, right? And that has to do with how taxes work, right? So presuming you finish that residency in the calendar year a couple of years from now or 3 years from now in 2023, and half of your year's income is going to be a resident salary and the other half is going to be your specialty salary, it's going to be kind of a blended rate, right? So it's not going to be, what you're expecting to earn on a tax year until the following year after that, right? So we can factor that into the student loan repayment simulation. If you're married, have kids, how you file your taxes, this is where you're going to input or change those settings here, right? And we'll run this simulation and see what it looks like, right? So the only downfall of using an income-driven repayment plan while you're doing your residency is that you're going to have a minimum monthly payment, right? And based on a $35,000 a year salary, it's going to generate a monthly payment of $132, right? But it's worth it to pay that $132 per month to keep that unpaid interest from getting added to your principal, right? And that's what we see here, right? So we had $225,000 when we started our internship as our balance. And now we've got an additional $25,000 of interest that have accrued over the last 2 years, right? But that interest doesn't get added to our principal, meaning that interest doesn't cost us any additional money unless it gets added to our principal, right? And the reason why these ones say 250,000 here is because if you switch repayment plans, they're going to take that interest and add it to your principal, right? So it's worth it to pay that $132 per month, right, under a plan like Pay As You Earn, to keep that unpaid interest from capitalizing, getting added to your principal. And if we come down here, we can see that if we make payments based on our income during our residency, and then even after, right, in this particular simulation, our total repayment costs over this remaining 18-year period comes out to about the same as if we were able to pay it back over a standard 10-year plan payment structure, right? Which actually wouldn't be doable while you're doing a residency, right? Because you can't make a $2,700 a month payment when you're making 35 grand a year, right? So you'll end up actually paying less using a plan like Pay As You Earn under this simulation and factoring in the forgiveness savings plan than you would even if you could pay it back over a standard 10-year plan time frame, right? So this is really kind of one of those game-changing moments here where, everybody is going to tell you you just need to pay your student loans back as fast as possible, but that's going to require a lot of income, right? I would rather pay a tiny part of my income, leaving me with the rest of it to do other things with, right? Even when I'm earning more money, right? So if we come down here, we can see some of these other graphs. So your payment's not going to be low forever. As your income goes up, your payments go up, and they may even get to a point here when you were factoring in your full specialty salary, $1,300, $1,400 a month or more of a monthly payment, but that's still less than a standard 10-year plan payment, quite a bit less, right? So when I said earlier, you want to calculate what does a standard 10-year plan payment require you to pay versus what does your income require you to pay. And even if you're making close to $200,000 per year here, we're still only making a payment on under Pay As You Earn that's $1,400 a month or so, right? So there's a lot of savings there. I would rather save that $1,300 per month that I can then use to work towards the down payment on a home, or maximize my retirement savings, or start a family, or start a business. All of those things that you can do when you have extra cash flow in your budget versus paying more than you have to towards your student loans, right? And then this loan repayment range graph in the simulator kind of illustrates this, right? There is never a point here, right? We're still, if we come back up, we're inflating your income in that scenario by more than inflation at 2.5%. So even 20 years into repayment, your income doesn't generate a payment that's what the standard 10-year plan payment was, right? So you have to be making a significant amount of money in order to justify paying a standard 10-year amount. And that's where we get into debt to income ratios, right? And that significant amount of money tends to happen once your income exceeds your total student debt balance, right? And that's where we'll come back and talk a little bit more about student debt to income ratios.
Tony, I want to take just a quick moment here. Somebody asked, and this is back to PSLF, but is there such a thing as retroactive PSLF applications where we apply for the program in the middle of an academic residency and meet all the other requirements and have the already completed years count towards the 10 years?
Oh, if you're lucky, right? So maybe it really depends. If you were meeting all of the, so the employment certification form is just a way of checking in. You technically don't ever have to submit one of those, but I would highly recommend using that just to make sure you're doing all of the right things. But you'll find out, right? So if you were doing all of those right things, if your loans were in an income-driven repayment plan and you were working at an academic institution, and they were willing to consider you an employee, they will give you all of the retroactive credit, right? But there are probably going to be some issues with that, right? And it's going to the biggest issue that I anticipate is whether or not your loans were in an income-driven repayment plan or they were in deferment, right? And we're going to cover that in just a few minutes here, because unfortunately, when you do an academic residency, and this happened to my wife, right? You all are often also doing a master's of clinical science or some other thing that puts you back into school more than part-time. And that tends to automatically trigger a deferment on your student loans. And if you don't turn that off, then that deferment is going to prevent you from getting any qualifying public service loan forgiveness time, right? So you have to actually proactively either tell them to ignore that in-school status if you have a master's associated with your residency, or actually once they do that, tell them to turn it off and never do it again, right? So there has to be an active part on an activation on your part to actually intervene there and have that reversed. And if you don't, then your loans get stuck in this deferment status until you notice it and then take it out of deferment. And that deferment, like we talked about before, doesn't count towards income-driven repayment forgiveness, nor does it count towards public service loan forgiveness. But you'll find that out, right? That's what you'll find out by submitting that employment certification form. It's always worth a shot. All right, so let's talk about debt to income ratio. So your income post-residency is going to inform your repayment strategy during your training, your specialty training here, right? So if you anticipate your debt to income ratio being 2-to-1 or higher, even after you finish your specialty training, then you're going to want to choose an income-driven repayment plan now, right? Plan for the forgiveness. You may not be able to save for the forgiveness now. Making 35 grand a year doesn't leave you a lot of room in your budget, but at least have it in your mind, right? So when you start earning some more money, that you're going to have to start saving something for that tax that's due on forgiveness, unless you're working towards public service loan forgiveness, right? In which case the goal there is to pay as little towards your student loans as possible and have the most forgiven tax-free. If your debt to income ratio is going to be 1 or less, then you're going to pay your loans off before you ever hit forgiveness. Even if you're working towards public service loan forgiveness, there's a chance that you may pay your loans to zero before there's anything to forgive, right? And that's because when your debt to income ratio is 1-to-1 or less, paying a standard 10-year plan rate or paying 10% of your discretionary income is going to result in pretty much the same thing, which is paying your loans to zero in 10 years or less. You can still use an income-driven repayment plan, and I actually would recommend it if you want to, peg your payment to a percentage of your income. That's when Repay really helps, right? So using Repay while you're a resident here and even after your residency will help you pay that balance off sooner and lower the total cost while still keeping all the flexibility that the federal student loans provide. A 1-to-1 ratio or less is also when a private refi becomes an option, right? You can still do that. You don't have to stick with the income-driven repayment plans. There's less risk associated with refinancing your student loans if your student debt to income ratio is going to be 1-to-1 or lower. There is this gray zone, and you may even move from a 2-to-1 either through the gray zone all the way to 1-to-1. And it really depends on, how soon you complete that arc, right? Or if you complete that arc, as to whether or not you should switch your repayment strategies. But if you're generally going to be in this 2-to-1 or higher, or maybe 1.5 to 1, even after your specialty training, then I would stick with pay as you earn, right? Because it's likely that you're going to hit forgiveness and you'll want to plan for the tax associated with that. But if you think you're going to be closer to that 1-to-1 or even less than 1-to-1, then I would use revised pay as you earn, because then the government's going to cover half of your interest while you're doing your specialty training. And when you pay that balance all the way to zero, you'll end up paying less than you otherwise would have because the government covered half of your interest during your specialty training, right? So Repay will actually save you a lot of money under that scenario. So consolidation, particularly here, I'm talking about a federal consolidation loan. You only need to consolidate your loans if you have some of those loans from outside the direct loan system. So those health professional student loans, loans for disadvantaged students, those older FEL program loans, if you want to put them all into a direct loan, that's when it makes sense to consolidate. Ideally, you would have done this right after you graduate. I mean, that's what we counsel veterinary students and new graduates to do, because it's also going to trigger one of those capitalization events. And if you do it while you're in the middle of repayment, it also restarts your forgiveness clock, right? So this is the only thing that it will actually restart your forgiveness clock, and that's consolidating your loan, because it physically issues you a brand new loan, replacing those older loans, right? And those older loans, if they had any forgiveness qualifying time, will get erased with the consolidation. You can't include a private loan in a federal consolidation, right? So there's no way to get a non-federal loan into a federal consolidation loan, unfortunately. But the federal loans are the ones that are all eligible for income-driven repayment, public service loan forgiveness. They have these blanket discharge provisions. If something should happen to you, your family is never on the hook for your federal student loans if something should happen to you. A private loan is completely different, right? You can still consolidate all of your federal student loans with a private loan, right? So that's commonly referred to as a private refinance, particularly if you end up with a lower interest rate. But private loans are much less flexible than the federal student loans, right? None of them, I have yet to see a private loan that even comes close to a federal student loan in terms of the flexibility that it provides. The nice thing about the federal student loans too is they're all consistent. That contract that we all signed when we took those student loans, or when you consolidate your loans, is the same for everybody, right? So everybody has the same terms and conditions. Private loans are all different, right? It really depends on your ability to negotiate and identify those things that might not be favorable for you, and approach that private lender and see if they're willing to change it so it is more favorable for you. A lot of the terms are going to be dependent upon your credit history and then the duration of repayment. And a lower interest rate does not mean that you're going to pay less towards your student loans. It can make it less expensive, but it doesn't automatically do that, not with student loans, right? And that's because of the differences, or what forgiveness and being able to pay based on your income actually does to your student loans. Oftentimes we see lower interest rates paying based on our income and planning for the forgiveness than any private lender can offer. So student loans are about more than just an interest rate. Before you ever pull the trigger on a private loan refinance, have somebody review it. You know, it's worth the cost. That probably costs you a couple $100 to have a lawyer review that. But you want to make sure you're not signing something that's going to be really adverse to you, or potentially a co-signer or somebody else that is going to be stuck with those student loans if something should happen to you, right? So have somebody review that before you pull that trigger, because there's no undoing it, right? There's no way to go back once you take your federal student loans out of the federal student loan system. You can include a federal student loan in a private consolidation, but you can't undo that activity. Okay, so this is if you're not using an income-driven plan, if your loans are in deferment now, or you're not sure, you definitely want to check, right? That's going to be something that's probably going to be really difficult to tell right now because of the pandemic. Specifically, if you're doing one of those master's programs and they put your loans into deferment because they recognize you were back in school, but we can try to tease that out. You can always apply for an income-driven repayment plan if they put you into deferment. You just have to be in repayment, right? So as long as you're in repayment, they'll consider an income-driven repayment application. If you're making 35 grand a year, right, this is how the payment works out. We already showed that in the simulator, right? So your minimum monthly payment would be $132 per month, worst case scenario there. Yeah, and this is kind of what we've already been talking about, right? So if you have an academic residency with a master's, beware of that auto deferment, right? You can contact your loan servicer and tell them, look, you're probably going to get some notifications about my student loans that say I'm back in school, but I want to keep my loans in repayment. Ignore those automatic deferment requests. They may even make you write a letter as such, right? But it should be sufficient to just request that they ignore that. But you may want to go the extra step and write them a letter and say, I do not want my loans to be in deferment. I want to keep them in repayment. And capitalization, this is really what we're trying to avoid, right? First thing to note, capitalization and compounding are different. Your federal student loans do not compound. This is actually what makes income-driven repayment so beneficial, is that your unpaid interest accrues along as unpaid interest, but that interest doesn't cost you anything additionally unless it capitalizes, right? Capitalization kind of has a compounding effect, but compounding would be continuous capitalization, right? And we just don't see that with federal student loans. That is a really common misconception. I can't tell you how many people tell me I have to pay off my student loans because they compound, or my financial advisor told me I have to pay off my student loans because they compound. They do not, right? And it's one of the huge benefits that come with your federal student loans. But you do have to try to prevent this capitalization, and that's where it's a little bit of work on your end, right? Not a ton, but a little bit of work on your end. There are specific events that trigger capitalization. So entering repayment, everybody who graduated from veterinary school would have had that interest that they accrued during vet school added to their principal when you started repayment or you started your internship. That's just part of the process. Consolidation will also trigger that capitalization. Changing loan status is the real big one, right? That's the one that encompasses deferment or forbearance. That's the big one in terms of residents and interns, right? And please do not defer your student loans, right? And if you have been, undo it, right? So you have the opportunity now, you have the information now to act on that. This is what triggers that capitalization, right? So taking that unpaid interest, and if you're early on in your residency here, you're not going to have a whole lot of unpaid interest. We've experienced almost this entire year here without any additional interest accrual. So you almost kind of get a shot at a do-over, right? Because of this pandemic and the fact that they turned off your interest, right? So you've had a significant chunk of time here where there was no interest accruing, but you want to take advantage of that. If you had your loans in deferment before, get them out of deferment and put them into an income-driven repayment plan. That auto deferment is still going to be stubborn, right? This is just kind of one of those vestigial remnants of this outdated system that we have for financing education, right? I mean, it makes sense if you think about it, right? When you go to school, they don't want to force you into making payments. But once you're done with veterinary school, there's really no good reason to have your loans deferred again, even if you're doing any kind of master's or PhD, right? I mean, you usually are getting paid something where you can afford the minimum payment on a student loans, or if you're not getting paid anything, you can still have a $0 payment under an income-driven repayment plan, and it would count towards forgiveness as well as prevent the capitalization event, which is what we're trying to do. Right, so keep your loans in that income-driven repayment plan. It'll decrease the interest cost to you, and it'll decrease the amount of time that you spend in repayment. So spread the word, right? This is one of the reasons I was so excited for this, trying to break this chain of word of mouth that has, our previous colleagues who deferred their student loans from telling you all to just defer your student loans, right? We got to break that chain, and you all are part of that, breaking that chain too, and passing that information along to the residents who are behind you.
Do we want to take a moment, Tony, and just talk about how, while this current time during COVID is called deference and forbearance?
Well, they call it forbearance. So the actually the law says they are suspending, right? And that's key, right? Now, because a suspension, they can say that the suspension, and they go on in the law to say that the suspension time still counts towards forgiveness, whether it's the taxable version of forgiveness or public service loan forgiveness. The way that the loan servicers implemented that suspension was through forbearance. Now, typically a forbearance period is not beneficial, right? So this is a very unique instance, and you're going to probably see this if you were in repayment before. When you go and log on to your loan servicer account, it's going to show that you're in forbearance. But the COVID-19, the CARES Act forbearance is a special kind of forbearance that's unique to this pandemic student loan repayment relief. And it has all of these provisions in the CARES Act that say, yes, it does count towards forgiveness. Yes, it does count towards public service loan forgiveness. And no, we're not going to capitalize your interest after this forbearance period ends, right? So there's specific language around this particular forbearance that we generally don't see around a normal forbearance or deferment.
Right. I just thought we should take a moment to say that because we're saying, don't do this, don't do this, don't do this. And yet at the same time, they might see that.
Yeah.
And I know that there are sometimes we get questions about concerns about, is the government really going to follow through? Is this something we should be concerned about, et cetera?
Yeah, and they cover that actually at Department of Education on that same page that we looked at earlier. Here, they have all of this stuff is actually laid out here on their coronavirus page, right? So they go through a lot of these particular, and this is also something that the person who asked the question that Fed Loan Servicing told them that information that we know to not be accurate, right, is also in here, right? So it will say if you're in income-driven repayment or how your loan should behave, and it doesn't say you have to take them out of the forbearance in order to get them to qualify. It actually says that the time that you spend in during this forbearance actually qualifies. Okay, loan forgiveness. So we're going to let's talk about that quickly here. I know this is way off in the future, but this again is one of those topics that leads to a lot of confusion. There's a lot of myths about student loan forgiveness, and a lot of people kind of throw it out before they even get a chance to look at whether or not it's going to be helpful for them, strictly because there might be a tax associated with it, which everybody thinks, yes, taxes are bad. Yes, nobody would prefer or would like to not pay taxes. But when we actually look at what the tax does to your overall student loan repayment costs, it actually can be extremely beneficial, right? So if you do make payments based on your income for the 20 or 25-year maximum repayment period and there's a balance remaining, then it will be forgiven, right? The law says that they're going to cancel any remaining amount of debt after you reach that maximum repayment period, right? So they're going to essentially hand it over to the IRS, right? And the IRS has been dealing with canceled debt for eons, right? So as long as debt has been a thing and the IRS has been a thing, there has been a way for canceling canceling debt, right? The unique instance here is applying it to federal student debt, right? So there have been instances of mortgages being canceled and medical debt being canceled, credit card debt being canceled, and all of those cancellation events result in a tax when that person files their taxes with the IRS that year, right? So we're just taking that same process and applying it to student loans, right? So if you're going to hit student loan forgiveness, or once you do hit student loan forgiveness, you'll receive a 1099-C in the mail, right? So they'll, just like if I were to go to Las Vegas and win $100,000, they give me a 1099-G for gambling winnings, right? The 1099-C just indicates that somebody canceled an amount of debt on your behalf, and you're going to have to report that on your taxes when you file your taxes, right? So you'll get a 1099-C that indicates the amount that was canceled. And then once you file your taxes and account for all of the other income that you earned and the taxes that you paid, you're going to fall into some tax bracket that's going to determine the tax liability that you incur as a result of that student loan forgiveness, right? So how much you have forgiven, what the tax rates are at that time, and what tax brackets you fall into based on your tax filing status and the state you live in and all of those sorts of things that determine your taxes. That's what's going to determine how much you owe the IRS by April 15th of that tax filing year, right? So you don't have to apply for this type of forgiveness, right? If you're using an income-driven plan and you reach the maximum repayment periods, they're going to cancel your student loans, whether you want them to or not, right? So there is no application associated with this, so there's no way for them to deny it. But you are going to have to be ready for it, right? There's also no mechanism for you to call them up and say, yeah, this isn't really a good year for me. I prefer to do this later, right? It's strictly triggered by the number of years or number of months that you've made payments on your student loans, right? So if you're going to hit forgiveness, you want to be aware of it, have an idea of how much you're going to have to pay in taxes, and then start saving for that, right? And that's what that forgiveness planning module in the student loan repayment simulator is there to help you get an idea of how much is going to be forgiven, what that tax might be, and then how you can save for it, right? So if I come back over to that simulation that we ran earlier, right, and I go to the forgiveness planning module, right? So if we just kind of work through the anatomy of this, right? So in this instance, if I make payments based on my income, I'm going to have $210,000 remaining. If I assume a tax rate on that of about 30%, that means I need $63,000 on hand when I anticipate hitting that forgiveness. And if I start working my way back, if I start saving $220 per month in a special account or set of accounts that earn me about 3% return per year, then I will have the $63,000 I need. And I've also reduced my costs even further, right? So now I've paid less because I used the power of compounding interest in this case to save for my tax on forgiveness. So it only cost me $48,000 to come up with the $63,000 that I needed for the tax, right? Which lowers my overall student loan repayment costs, right? And this is where this becomes more beneficial, but it's a little bit more work, right? I mean, you're going to have to check in on this, adjust it as your income goes up or goes down. As tax rates change, right? We may have to change this tax rate, or if you live in a state that has a high state income tax, you may have to increase that a little bit to account for that, right? But you can do all of that in this forgiveness planning module to help you understand what that implication would be and how much you might have to adjust your forgiveness savings plan. All right, so yeah, it is completely different, and this is where I see a lot of people, they kind of use some of the data that's come out around public service loan forgiveness, and they're like, oh, look, the Department of Education isn't going to honor forgiveness. Look at how bad public service loan forgiveness is. That means that income-driven repayment forgiveness is doomed as well, and they're completely different. They're written completely different in the law. They're handled completely different when it comes to forgiveness. So what's going on in public service loan forgiveness, which is really unique, has no bearing on what's going to happen with income-driven repayment forgiveness, right? So don't get sucked into some of that nonsense that's been perpetrated out there when it comes to that. We've even written a blog post on identifying the differences between the different types of forgiveness. So what if, right? So what if you get married, if you have kids, you're going to have a tax on forgiveness. We kind of covered that. Bonus pay, production. A lot of you are probably going to be paid on production. How do you factor all of that in? And honestly, all of that can be worked in to your simulation, right? So if you know that your taxable income is the input that they use for your income-driven repayment, that's what you can put into the student loan repayment simulator. You can factor in whether you're married, your tax filing status, how many kids you have. All of that goes into that federal poverty guideline calculation with the discretionary income, and will be adjusted for that in your overall simulation. We also have an area on VIN where you can post your questions, right? So if you get to the point where you've run the simulations and you're still just not clear on which repayment plan or strategy you should take, you can post in the student debt message board area. You can post anonymously in there, right? So we have a VIN student debt message board area. So if you have access to VIN, I know all the academic residents here have access to VIN for free. So if you're not taking advantage of that, jump on there, right? The private practice residents, it's super cheap, right? So if you don't have access to VIN, we also have a VIN Foundation student debt message board area, right? So we have a free way of doing this. We also have a way that's included in your VIN membership. So if you have questions or you want a personal consult, there should be no barriers there to getting the answers that you need. And then by posting, our community, our colleagues behind you, and that are also having those same questions also get the answers that they need.
Tony, somebody's asking a question here about PSLF that I'm just going to ask because you touched on it earlier, but in regards to PSLF, for people that met the criteria after 10 years,
yep.
How many people actually had their loans forgiven? The news reported many people were denied.
Yeah.
How realistic is that the government could cap the forgiveness, and how could that impact you? Would you no longer be able to obtain complete forgiveness, even if you had been part of the program prior to the change?
Yeah, great. No, great question. So the most recent numbers that I have is that 4,000 people have been granted forgiveness under the public service loan forgiveness program that did not have to pay taxes on the amount that was forgiven, right? So about 4,000 people have been able to successfully achieve public service loan forgiveness. So it has happened, right? And that number, that percentage of those folks who are applying and being granted public service loan forgiveness is increasing every quarter that they publish those numbers. The changes that you're referring to, so the caps on public service loan forgiveness, are proposals, right? Those have been proposed for a number of years by a number of different Congresses, and none of them have passed. And even if they were to pass, none of those proposals are proposing to change public service loan forgiveness for people who are currently working through it, right? So all of these proposals are to change how public service loan forgiveness works, or maybe how student loan repayment works for those folks who haven't even started borrowing yet, right? So all of us who currently have student loans have a master promissory note, a contract that are associated with those loans, right? The direct loan master promissory contract. All of those things are baked into that contract, right? So for them to change the existing rules midstream for those of us who are in repayment or currently borrowing or working towards public service loan forgiveness or whatever, they would essentially have to tear up 44 million student loan contracts, right? Which is why none of them are proposing to do that, because that would be a holy hell of a mess, right? So all of the proposals are to change how student loans work in the future so they can write a new contract that people who haven't started borrowing yet would sign, right? So I wouldn't worry too much about the student loan repayment programs or things like public service loan forgiveness changing for those of us who are already in repayment, right? It's highly, highly unlikely. But great question. It's one that comes up a lot. Okay, so these were some of the questions that you all included, right? So I want to make sure we cover some of these in case we haven't already. But so how will the debt affect your ability to purchase a home? Also, how paying the loan for 20 years will affect your retirement savings. So neither of them have to affect you at all, right? And if anything, income-driven repayment has helped us purchase our homes better than if we were trying to pay using different repayment strategies, right? It pegs our monthly payment to a specific amount, right? A low percentage of our income. If we were using something like a standard 10-year plan payment and it turned out that that was 30% of our income, then we're not going to look like a very good borrowing candidate when we go to apply for a loan, right? But the fact that it's no more than 10% of our income means that we can afford to have something like a mortgage, right? Even while we have our student loan balance. So these things can actually make it easier for you to purchase or afford a home. Same with retirement savings, right? If I'm trying to pay off my student loans, that money has to come from somewhere, meaning I'm probably going to sacrifice other areas of my financial wellness, maybe something like a retirement plan. It doesn't have to, right? I'm going to make sure that I'm maximizing my retirement savings before I think about paying more than my income requires me to pay towards my student loans, right? So you can maximize your retirement savings. And if you're doing those through things like 401ks or other taxable, tax-deferred types of benefits, you'll also reduce the amount of taxes you pay. It will reduce your adjusted gross income, which also reduces your minimum monthly student loan payment. Right? So these things can all work synergistically when it comes to building a comprehensive financial wellness plan if you choose the right strategy. I think we covered the viability of the student loan forgiveness programs there with the last comment on some of those proposals and your master promissory note. Paying off the higher interest rates loans first, I generally don't recommend that unless your debt to income ratio is less than 1. Right? Those types of strategies, essentially this avalanche method of paying off your student debt, even the snowball one, which is really not, if you're going to use one of those two, the avalanche one is the more cost beneficial. However, it only makes sense when your income can support it. And that generally is only the case when your debt to income ratio is 1 or less. In the long run, is it better to pay it off or have it forgiven? Let your income decide. Right? It really is going to depend on your circumstances. A lot of things are going to happen, right? I mean, you may finish your specialty, make a whole bunch of money in the first few years, start a family, end up having to take some maternity leave or whatever, and then there'll be a hit to your income potentially, right? I mean, you don't want to, give up too much of your income or pay more than your income requires towards your student loans, because ultimately that's going to come from somewhere. It's going to come out of the rest of your financial wellness plan. So, I'm just going to let my income determine that. If I pay my loans off before forgiveness, great. Congratulations, right? If I don't and I hit forgiveness, great. As long as I'm prepared for it, my student loans are still gone, right? So congratulations. So either way is an acceptable and viable way to pay back your student loans, right? And I'm going to, use the one that's going to provide me the most flexibility and give me the most cash flow in my monthly budget. This one is an interesting one that I'm hearing more and more frequently. So my low interest rate is so high that I've been told to pay off the loan before I invest for retirement, right? So there's a couple of problems with this. Your retirement savings are going to be compound growth over decades of time, right? The money that you contribute towards your retirement are going to way outgrow any benefit of paying off your student loans earlier, right? So your student loans operate on what's called simple interest. Compound interest or compound growth in your retirement savings is going to beat out a simple interest student loan any day of the week and twice on Sundays, right? So this is not really a good way to look at your student loans when you're trying to say either or. It shouldn't be an either or exercise. Okay, so let's finish up and we'll just talk about some of these items that I see a lot of people making mistakes in terms of their overall financial wellness, right? So I see a lot of people prioritizing their student debt over credit card debt or private loans. Pay credit card debt, private loans first, right? These are less flexible. These will do more damage to your credit score than your student loans will, right? So get rid of this stuff first. Even though the student loan is probably a bigger number, these are going to have a bigger impact on your overall finances, right? So get rid of those things first. Build an emergency fund, right? It's going to be tough to do while you're a resident. If you can, great, right? You want to try to avoid coming out of your residency with credit card debt. That can be tough. I know it was really tough for my wife. She lived in a really expensive area where she did some of her internship training. It was really hard to get out of that without some credit card debt. But if you have an emergency fund, if you have the ability to build an emergency fund, that can be what keeps you out of credit card debt, right? So when you get the opportunity, try to get 3 to 6 months of your either use your income or you can use your expenses. Just give yourself a target and start working towards it. It's better to have some bit of emergency fund than having to rely on a credit card. And then long term, an emergency fund it'll be what keeps you out of credit card debt long term. Building retirement savings, again, this is not something that probably applies while you're a resident, but once you get done with your residency, you're going to have to play some catch up, right? I mean, we're already a little bit late to the retirement savings game, just as a function of how much time we spend in school, and then you do a residency and you're adding more time on top of that. You are theoretically increasing your earnings potential, right? So you can play catch up, but that means you're going to have to dedicate a higher percentage of your income towards your retirement savings, right? And ideally, you're going to want to target those kind of tax deferred types of contributions like 401ks, Roth IRAs, those types of things that you have the ability to grow tax-free long-term. Saving for down payment on our home or practice, for us, it was way more beneficial to use income-driven repayment, work towards a 20% down payment on our home. That's gave us the optimal financing for a house in a pretty competitive market like Denver, right? So, I would really encourage you all to use that time that you have right out of your residency where you can still keep your student loan payment relatively low based on how I showed you before, how your tax return is going to work. You probably still have a window of a year or two before your payment goes up appreciably. That's where you can use that to start working towards that down payment on a home or working to play catch up on those retirement savings or both. If you're going to hit forgiveness, plan for it, right? That's what the student loan repayment simulator is going to help you navigate. If you keep plugging different income inputs in there and it keeps showing that you're going to hit forgiveness, make sure that you're allocating some amount for that forgiveness savings plan. And enjoy life, right? Don't let your student loans prevent you from doing anything. I've got a little bit of a fly fishing addiction, to say the least. We had a traveling addiction before the pandemic hit, but I'm still able to exercise the fly fishing addiction living out here in Colorado and the Mountain West. So, our student loans do not prevent us from doing all those things outside of our professional life that we really enjoy to do. Okay, so last I guess word of caution is something that I call traumatic statement syndrome, and I figured if we gave it a medical sounding acronym, maybe we can treat it, right? So TSS is kind of this frustration with your student loans, and particularly when you're using an income-driven repayment plan, you can see that loan balance increase until you can get to a point where you're covering the interest and it's knocking down the unpaid interest and it's actually reducing the unpaid interest and maybe even eventually the principal. But watching this long term can have some temptations to really try to pay your loans off before your income allows, to refinance them before your income allows. It really just wants you to, kind of call these things out so you can identify them, and then just help you to understand that it's okay to keep paying based on your income. It's okay to have a student loan balance, right? It's either going to be gone because you earned enough to pay it to zero, or it's going to be gone because you hit forgiveness, right? Either way is going to be okay. Just don't jump the gun before your income actually allows it, because that's when you can expose yourself to a lot of risk. It's really tempting now to think that I just want to refinance my student loans. I can get a really, really low interest rate. Again, that's only going to be the case if your student debt to income ratio is less than 1, right? And you're still trading something that's really flexible for something that's less flexible. So be really, really careful. Know what you're giving up. Know what you're getting into. Have somebody review that private loan refinance arrangement, and watch your unpaid interest, right? So some of you are going to have some pretty significant unpaid interest balances as you work through your residency. And even if you finish your residency and you start earning more money than you ever thought you would, you may still have an unpaid interest balance that lingers for a little bit. And if you refinance your loans while you have that unpaid interest balance, they're still going to take that unpaid interest and add it to your principal. So even if you do get a lower interest rate, you're going to have a higher principal balance, right? So you may still end up generating the same amount of interest per month that you were generating before, right? So just be a little bit careful. This is just how these work. There's no way for them to refinance your federal student loans without also taking the unpaid interest and then adding it to your principal balance, right? So if you're going to refinance, it probably doesn't make a lot of sense to do so until after your unpaid interest balance is paid down. All right. So if I didn't make this clear enough, we'll just put it in big red lettering. So don't defer. If you are, get them out of deferment. Use this as an opportunity to correct that. Go to studentaid.gov, find out which of your loans are qualify for income-driven repayment. Consolidate some of the ones if you have to get them to qualify for income-driven repayment or public service loan forgiveness, and then make sure that you get them and keep them in that income-driven repayment plan. If you need help, post on VIN or VIN Foundation student debt message board areas, and you can post anonymously in there. Get credit during residency if you can, right? So again, just to review that quickly: direct loans, income-driven repayment plans, and the 501c3, which is usually the easiest part to meet, right? So make sure that you have those other 2 checkboxes, all direct loans and using the right income-driven repayment plan. Bring that employment certification form to your HR rep and see if they'll help you qualify, right? It's not a, it's a pretty gray zone, right? I mean, it really, if you can get them to work with you, you can probably get them to call you an employee, right? I don't understand some of the ones that are real sticklers about this. I mean, we're really splitting hairs here. So try to encourage them to do that. And if anything, it's going to make that residency even more appealing to those behind you as well. So, I mean, I would hope that some of these institutions are going to use that as almost like a recruiting tool to help them get them started towards public service loan forgiveness. You never know where your career is going to end up, right? So fellowships, PhD programs, maybe you'll end up staying in academia. Who knows, right? And there's no reason to pay more towards your student loans than you have to. So if you can get credit towards that public service loan forgiveness now while you're in potentially your academic residency, then you'll reach that tax-free loan forgiveness even sooner. So just some guidelines, to cover again. If your debt to income ratio is going to be greater than 2, you're going to want to stick with an income-driven repayment plan, probably pay as you earn. Pay the minimum, plan for the forgiveness. If your post-residency debt to income ratio is going to be less than 1, I would use repay during your residency and stick with repay until you pay your loans off, or you get to a point where your unpaid interest balance is gone and you can get a good deal on a refinance. That might be the time to pull the trigger there. If you're in between, right, this is probably the toughest decision point, right? So you're going to have to run some simulations. It's not going to be wrong to use either pay or repay, but you may see one that looks like a more clear winner depending on where you think you're going to end up and what your income is going to be, and then you can adjust as your situation evolves. focus on your financial wellness before paying any more than you have to towards your student loans, right? There's no reason to play this, either or game, right? You can definitely save for retirement, even maximize the amounts that you can contribute on a tax-free basis per year. Should be easier as specialists to do something like that. Don't sacrifice any of your other financial goals because of your student debt. Your student debt are not going to prevent you from doing anything, right? But paying more than you have to or more than your income requires, that can't, right? Because you have fewer resources to work with. You've got a lot of time left. I'm sure there's a lot of questions that are going to pop up along the way. Just know that we're here to help, right? I mean, that's, we've accumulated a lot of information and experiences from your fellow colleagues on best practices here, and we're really trying to share those with you. Take advantage of those so you can stay out of those same holes that many of us have already fallen into, and you'll also help your colleagues behind you avoid those mistakes as well. So ask lots of questions. We're definitely here to help. And anything that pops up along the way, please reach out and let us know how we can help you further.
Wonderful, Tony. We do have another question that just came in.
Sure.
I'm currently in payee and I'm afraid of being kicked out of the repayment plan. Is it just based on the 10-year standard repayment? If my annual taxable income, 150% poverty line, is greater than the 150% poverty line, is greater than the annual standard 10-year payment, could a one-time large income kick me out of it's the criteria during the 1 year? Is the standard 10-year payment based on principal or the principal plus interest? Did that make sense?
Yeah, and I think it comes down to the fear of being kicked out of a plan, and once you are in, and you said you're in pay as you earn, you cannot get kicked out, right? There is no scenario. You can choose your way out, right? So if you choose to use a different repayment plan, they'll put you in a different repayment plan. But you cannot get kicked out once you are in an income-driven repayment plan. But a plan like Pay As You Earn has a stipulation in it that if your income generates a payment that's higher than the standard 10-year monthly plan payment when you entered that income-driven repayment plan, then that will be the cap that you'll be required to pay under Pay As You Earn. Don't think of it as a penalty, right? If you have a huge increase in your income and your taxable income generates a monthly payment that is greater than the standard 10-year plan payment, congratulations, right? That is cause for celebration, right? The worst case scenario there is that your minimum monthly payment, let's say that you were this person and you had $225,000 of student loan, you had an unpaid interest balance, and your income jumped to a $350,000 or $400,000, which is pretty much what it would need to be in order to generate a payment like this under Pay As You Earn. If that happens, that means you'll still be in Pay As You Earn, but your minimum monthly payment will be this amount, right? And it won't ever be higher than that amount. But you can choose to pay more than that amount if you want, because at that point, your monthly payment is actually less than 10% of your discretionary income, right? So that provision that's in Pay As You Earn is actually a beneficial provision, right? So don't think of it as something that's going to hurt you long term, right? It just means that your income has gotten to a point where it's like, okay, great. Well, you don't need a reduced payment anymore. You can afford to pay the standard 10-year payment, and that's what they'll set your minimum monthly payment to. And you'll keep making that payment as long as your income remains at that level, right? And you'll either pay your loans to zero in 10 years from that point, or it might take you a little bit longer because you've got some unpaid interest balance or whatever. But the payment will never be more than that standard 10-year plan payment when you initially entered income-driven repayment, right? So I hope that makes sense, and it kind of takes some of the edge off around that. But that is another one of those kind of really common concerns that I hear from veterinarians, is they're worried about getting kicked out of the repayment plans. For you to be able to do that, first of all, your income needs to be really, really, really high, which again, congratulations, right? There's never a problem with making too much money. So if you hit that point, celebrate, and your payment will be set to that standard 10-year amount. You can keep it at that, or you can choose to pay more at that moment if it makes sense to do so. Now, if your income drops after that, right, then you can still have your payment reduced to a level that makes sense or matches 10% of your discretionary income, because you're still technically in pay as you earn, right? So you don't ever get removed from an income-driven repayment plan once you're in there. It's just your payment gets adjusted upwards or downwards based on what your income is. And pay as you earn and IBR actually have these goofy caps on them that are tied to the standard 10-year monthly payment plan rate. But those caps are good things, right? I mean, if you hit those caps, again, you're doing well.
Okay, wonderful. That's all the questions that we have right now.
Cool. Great.
So thanks so much, everybody, for coming. Yeah. And for those of you that requested CE, we will follow up with you for those CE requirements. And you can email us at studentdebt@vinfoundation.org or reach out to Shannon, or please reach out to that VIN or VIN Foundation student debt folder. And if you're not sure how to access that, feel free to email us again at studentdebt@vinfoundation.org or email Shannon. Shannon, is there anything that you wanted to say before we go off here?
Thank you, Tony, so much. That was awesome. And I'm sure everybody took some pearls away. So, and thank you guys all for coming.
Absolutely. Yeah. Thank you all for coming and sticking through it, and good luck. Stay safe, stay healthy. And again, please let us know if any questions pop up along the way. You don't have to figure this out all on your own. So we're here to help.
Thanks, everyone. Have a great night.
Yep, absolutely.